Good afternoon. Thank you for joining us this afternoon. My name is Debbie Crabtree. I'm the Accounting Service Manager along with the Employee Benefit and Payroll Consultant here at Sikich. And this afternoon I am teaming up with Jenny Andrews, one of our HR consultants, to present to you payroll and HR best practices, what you need to know for year-end and beyond. Here's the agenda for what would be the first half of today's webinar that I'm going to cover. We're going to go through payroll best practices and tax issues, common questions related to the taxability of fringe benefits, preparing for year-end payroll, along with payroll reconciliations and deadlines. So what you'll find if you have downloaded the presentation today is that we have many slides to go through. So we may find that we're going to gloss over some information so that we can highlight what are the new laws and requirements that have come out in the last year. However, we're providing the entire presentation so that you can review the information at a later time, and if you have any detailed questions about the additional information, you can certainly contact us. So in the area of payroll best practices, the first area we would recommend that you take a close look at is what your payroll system looks like, how it's set up, and what the workflow is. Specifically, we recommend you have as much information automated as possible, such as linking the federal and state withholding tables to your payroll system so that there are no manual calculations. Secondly, would be consider setting up a separate payroll bank account with sweeping features. This is often called a zero balance account. This will help in reducing the amount of transfers that are needed between a payroll bank account and operating bank account. This will also isolate and zero in on your payroll activity to be with one specific bank account. The next item related to payroll system and workflow would be to review your general ledger setup. We do recommend that you have separate liability and expense accounts in the general ledger, again, to isolate those transactions so that you can determine if all of the liabilities have been paid out to the different entities that they're owed to, whether it be a 457 plan or the feds or the state. The next topic on payroll best practices is to verify that your employees in your system who are being paid, they do exist and that their information is accurate. Specifically here I want to highlight the second two bullet points on the screen, which is two services that are available free from the government that allows you to verify the information that an employee has submitted. So the first is the E-Verify service, which is available on the U.S. Citizenship and Immigration Service website. And this allows you to enter information on an employee, such as their Social Security number and their name, and to confirm that that is what has been submitted to the government. The second service is very similar. It's the Social Security number verification service through the Social Security Administration website. Again, this is free, it's easy to use, and it allows you to verify information, and you can do a couple of people at a time, or you can upload an entire database and receive the results the next day to verify the information. The last topic on payroll best practices is time tracking and making sure that we're being as efficient as possible, tracking time in an electronic system versus manual spreadsheets or timesheets, and that the information is reviewed by a direct supervisor who's involved with the employees on a daily basis and can confirm that the employee has worked the hours that are on the timesheet. And we recommend that you have implement checks and balances within the payroll department. So, for example, making sure that someone other than the person completing the process is reviewing the timesheets and the payroll that is being processed. We're on to payroll tax issues. So a couple of things I want to highlight here. The first screen is specific to federal taxes. You have your employee, you have your employer's information here on the screen. Social Security continues to be at the 6.2% for both the employee and the employer contributions. The wage-based limits for 2016 was the $118,500 for 2016. That has been increased. Those that were announced a couple of weeks ago for 2017. It is increased to $127,200. On the area of Medicare, it continues to be at the 1.45% for both employee and employer with no wage-based limit. And the employee, a couple of years ago, we had the additional Medicare tax on the 0.9% over $200,000 in wages. There are specific calculations on how to determine what needs to be withheld from an employee if they do fall within this category, but I do want to mention that. And then we have, of course, the federal withholding, which would be based on the allowances as entered on the employee's W-4 form. And then the remaining items on the employer's side would be the federal unemployment. However, keep in mind, I know we have several governmental agencies here on the line today, that federal unemployment insurance, that tax is not applicable to governments. On the state side, speaking specifically for Illinois, you have your Illinois withholding, and the employee should be filling out an Illinois W-4 indicating how much to withhold. And you have your state unemployment based on the rates from the Illinois Department of Employment Security. Those rates will be issued coming up here in December and would be applicable for 2017. If you are a local government agency, there are some different options available to you related to how you pay out SUI. If you would like additional information on that, please contact me, but I know that's government specific. The frequency to remit payments for payroll taxes, the deadlines are established based on a look-back period. For the most part, most companies and entities will be set for how often they do need to make payments. If there are any significant changes in your workforce, you may be advised of a change on how frequently you need to remit taxes. And so just be alert for any notices from the IRS if that is the case. The last item in this section would be to review federal and Illinois withholding. Again, the W-4 would be submitted for Fed and Illinois W-4 for the state withholding for employees. There is no requirement that employees submit this at any point in time unless they want to make a change, but it is nice to remind employees that they can submit it at any point in the year. Just to remind them that if they had a change in filing status, they want to change the amount of withholdings. And also you could potentially find out if they've moved and just had not submitted an address change yet. Our next section is on the common questions related to fringe benefits. The first is on gift cards. What's important here is to understand that any gift cards that are convertible to cash is taxable compensation to the employee. So there are specific rules, and it is very rare that a gift certificate would not be taxable to an employee. So in general, gift cards are taxable because it is convertible to cash, which is always a taxable compensation. This is specific to our governmental folks out there. The benefits to aldermen and to trustees is that anyone who's being paid, they are considered employees, and they should receive a W-2 and not a 1099 miscellaneous. And when they receive the W-2, be sure to consider if there are any fringe benefits that are being received by the individual throughout the year. So they may not include any cash compensation, but if they are receiving fringe benefits that fall within the compensation, they may need to receive a W-2. And I have a couple of examples here on the slide. The next section in the area of fringe benefits is the employer-provided vehicles. Personal use is considered taxable, and there are exceptions for qualified non-personal use vehicles. Again, this is government specific, but I do want to mention that that qualified vehicles in general would be clearly marked police and fire vehicles, or if they're unmarked, if they're being used by a law enforcement officer who is authorized to carry a firearm or execute a search warrant or make an arrest. So the next couple of slides give some very detailed facts from the IRS regarding when it is considered an employer-provided vehicle, if it needs to be taxable to the individual who is using that. Employee cell phones. So several years ago, prior to 2011 actually, cell phones that were provided to employees needed to be tracked, detailed records of how much time the employer-provided cell phone is being used by the individual, whether it be personal time or business time. The IRS in 2011 determined that it is not taxable to the employee and that detailed records no longer need to be maintained. Uniforms and work clothes. This should be under an accountable plan so that the employee is being reimbursed a specific amount. The clothing must be worn as a condition of employment, and items that are not suitable for everyday wear would be taxable. Oh, I apologize. That are not suitable for everyday wear is where it becomes that it's not taxable, such as a police officer's uniform, a letter carrier, etc. Any clothes that are used for everyday use, and a common example would be police detectives that would go and buy khaki pants and a button-down shirt because that's what they're allowed to wear at work every day. That would be something that they would wear on the weekends and would be considered everyday clothes, and that would be considered taxable to the individual. Group term life insurance, you can exclude up to $50,000 of group term life insurance coverage. Anything in excess of the $50,000 is includable in wages, and the IRS publication 15-B has a table to determine how much income needs to be put onto the W-2. This type of income is not subject to income tax withholding, and it is subject to FICA and Medicare taxes. I've actually seen the group term life insurance taxed in a variety of ways. One would be you can tax throughout the year based on the employees and just space it out throughout the year. You can also put the last on the last check of the year for the entire amount that is taxable, or you can just update the W-2. Okay, so preparing for year-end payroll. A lot of the items here on this slide I'm going to gloss over because we've covered some of the information already, but this would just be more of a checklist of what needs to be considered as you're preparing for year-end. Once again, we recommend that you verify the employee information using the Social Security number and the information that I already described on the other slide with those websites. In preparing for the W-2s, consider the personal use of company vehicles, and if that is a taxable fringe benefit to the employee, to make sure to put that onto their W-2. We also have medical insurance premiums for S-Corp shareholders. We discussed the group term life insurance over $50,000 if that needs to be added. On the topic of annual bonuses, if you are going to give any bonuses, make sure the check date is 12/31 in order to count the bonus as income in the current year. Early retirement incentives. If you have given any early retirement incentives to any employees throughout the year, one hot topic that has hit in the last couple of years is that many companies and entities had offered early retirement incentives. And one of the areas that the IRS has honed in on during their IRS audits and compliance checks is what was offered to employees for early retirement. And one of the items that they specifically have ruled on, and in some cases fined and had to settle with employers on, is the area of health insurance. If they are offered health insurance, but there's a cash alternative to that, whether they choose the cash, which would be taxable, if they choose the health insurance benefit, that also becomes taxable to the employee. And the key piece is that the cash alternative was offered. So that would be something to look at if you are considering an early retirement incentive, and making sure that this information is properly taxed, because that is a hot topic on the IRS compliance checks. The next item on this slide is the clothing purchases for employees, of which we have already discussed. 401k contributions. Well, while this specifically lists information on 401k contributions, this could be on the topic of 457 or any type of alternative deferred compensation, anywhere that employees may be putting money aside and having the money put into an account. You want to be aware of the details of the contribution amounts that are allowed for these different types of accounts. I have the 401k contributions for 16, and that actually is the same for 17. Those came out a couple of weeks ago as well. The last item is related to the W-2 reporting of health coverage. So this continues. There are no changes in this area. What this is several years ago, the IRS came out and indicated that any employer with 250 more employees are required to report information on the W-2 for employees. So if you have less than 250, you're not required, but you could opt to do so. And I do have a couple of clients that have opted to do so. And what this is reporting the information, the employee and the employer costs on the W-2. It does not mean that the amounts are taxable to the employee. It's more informational. It's reported in box 12 with the code DD. Some employers have opted to do this even if they don't have 250 employees, because they want the employees to know and understand the total benefit that they are receiving, even if so that they can see the employer cost that the employer is picking up in the form of health insurance coverage. And then the last item here are the employer-provided cell phones, which we spoke about earlier, and the fact that those are not taxable. Okay. Our last section that I'm going to cover before I turn it over to Jenny is the year-end payroll reconciliations and deadlines. So just a couple of items to consider as the year is wrapping up, as you're wrapping up the quarterly 941s and preparing your W-2s and W-3s. The first one would be review the bank reconciliations for any uncleared paychecks. You need to confirm with the employee if the paycheck has been cashed, or if they lost it, you need to reissue. Any uncashed paychecks will become unclaimed property, and the timing and the procedures do vary by state and the type of entity that is holding the funds. When you're reconciling the information, you want to add up your quarterly 941 information to tie to your W-3 and your W-2 information. Before, we recommend that you hold off on filing your fourth quarter 941 until all of the W-2 and W-3 information is prepared and ready to be sent out. In case there are any discrepancies that occurred, you can correct that in the fourth quarter 941 without having to do an amended 941. And then the other item would be your W-3 summary, which would show total gross wages. You should compare that to your financial statements to confirm that the salary expense on your financial statements is what is shown on your W-3. And then the last tip as your year-end, which I had mentioned earlier, was to watch from the Illinois Department of Employment Security for what your percentage would be for the SUI withholding for your first quarter of 2017 payroll. Okay, deadlines. This is very important. There is one big change that I wanted to mention today, which is, first of all, your deadline to submit W-2 forms to employees is still January 31st, so that remains the same. However, the big change this year is that W-2 and related forms is due to the Social Security Administration by January 31st as well. So in the past, the employer typically had until the end of February if you were filing on paper, or the end of March if you were filing electronically. Now, and the reasons here are listed on the slide, the IRS has now made the requirement be January 31st that the information needs to be sent to them. They believe it will help them detect and prevent refund fraud now that the employers are required to send it in earlier. The other item I wanted to mention, for most of you out there, you also have 1099 miscellaneous forms where you report non-employee compensation, such as payments to independent contractors. And this change also affects the reporting deadline for those forms. If you are reporting non-employee compensation in box 7 of the 1099 miscellaneous form, that is also due to the government by January 31st. And then the last item here is what rolled out with this deadline change is that there are changes to requesting an extension to file the W-2 forms. There's now only one 30-day extension, and this extension is not automatic. And we recommend you take a look at Form 8809 for more detailed information on how to file an extension to submit your W-2 forms to the government. Okay, so as I wrap up my section, I also wanted to share with you a couple of useful references here, some different websites and information. And certainly if you have any questions, feel free to submit any questions that you have, and we'll try to cover them at the end of our presentation. So I'm going to go ahead and turn it over to Jenny.
Good afternoon. Thank you for joining us. My session, or my part of the session, I'm going to be talking about the Department of Labor overtime rule. And so the agenda today, we're going to do a highlight of the basics of the overtime rule. I'm going to talk about the final rule overview, meaning the changes that just went into effect or will go into effect on December 1st, and what your next steps would be. So first of all, let's talk about what is FLSA. You will hear that referred to a lot during this presentation. That is the Fair Labor Standards Act, which was passed in 1938 as a federal law. It is enforced by the Department of Labor, and it primarily covers minimum wage, overtime, exempt, non-exempt, child labor, equity, equal pay, and record keeping. So the basics of the overtime rule is under the Federal Labor Standards Act, an employee who is non-exempt, and that's key, not exempt, must receive at least minimum wage for all time worked and overtime pay, which is 1.5 times the regular rate of pay for any hours worked in excess of 40 hours in a work week. Okay. So here's some basics that I think that there's a lot of misconception by people. How an employee is paid. It's either hourly or a salary. A status is the employee's position is either non-exempt or exempt. So if you're salaried, it does not automatically mean that you are exempt. And if you're hourly, it does not mean that you are automatically non-exempt. And that's where there's been quite a bit of confusion for people. Okay. So the exemptions. As I mentioned before, the overtime rule applies to those people that are not exempt. So if they're not exempt, they need to be paid overtime. If you are an exemption under one of these categories, you would not be eligible for overtime pay. So if you're an executive employee, administrative employee, or professional employee, computer employees, or outside sales employees. And you will often hear this referred to as white collar or EAP. There are 3 tests for the exemption. There is the salary base, salary level, and job duties. And for the salary base is a guaranteed minimum amount of pay each week in which they perform work. The salary level is a minimum weekly salary threshold, and job duties is specific criteria for work performed. So we're going to give an overview now of the final rule, and what I want to clarify on this is this rule went into effect in 2004. So a lot of people are referring to this as the new overtime rule. What I would like to refer to it as is the revised. It's always been a policy that there is a duties test, and for somebody to be exempt, they must meet a certain threshold. Well, that threshold has now changed and has been raised. There has been a couple changes that went into play, but I refer to it as the revised overtime rule. In March of 2014, President Obama put into motion that he wanted this rule changed and to make it simplified, modernized, and updated. And that change has been done and will be effective December 1st of 2016. The minimum salary for exempt employees increases as of December 1st from $455 to $913 a week. That's a drastic change. The reason for that huge increase is that that salary minimum was set in 2004, and there hasn't been a change since then. So they have put this in to raise that up to $913 a week. They also increased the minimum salary for highly compensated employees from $100,000 to $134,004. And they're also establishing a mechanism for automatic updates every 3 years, and that's so we don't fall into this same bucket as we are right now that we've went so many years without an increase. So just an overview, for the highly compensated, they've increased the annual salary to $134,004. They must be paid $913 weekly. The non-discretionary bonuses, incentive pay, or commission may not be applied to the $913, but it can be applied to their yearly threshold. And you'd want to check your state laws. For example, in Illinois, they did not adopt the highly compensated exemption, and it was not identified in the Wisconsin state law. So therefore, it just falls back to having to pay them at least $913 a week. So we talked about automatic updates. So the salary will update every 3 years beginning on January 1st of 2020. At least 150 days before the effective date, which in this case would be August 3rd, 2019, the Secretary will publish a notice in the Federal Reserve of the updated salary and the total annual compensation amount that will be required. In their eyes, the 150 days will give employers enough time to do a review and make that decision if they're going to bump it or if they're going to take some other steps, which we'll discuss later. And how was the salary level determined is what most people are asking because that jump was so huge. The standard salary level was based on the 40th percentile of the weekly earnings of the full-time salaried workers in the lowest wage census region. And the highly compensated employee was the 90th percentile of the annualized earnings of the full-time salaried workers nationally. So earlier I had mentioned non-discretionary bonus and incentive pay. So under that, this part is new. Up to 10% of the non-discretionary bonus, incentive pay, or commission may be included if it's paid at least quarterly. So you can pay your employees $822 a week instead of $913 a week on a salary basis, and then pay at least $91 or $1,092 per quarter or more frequently in non-discretionary bonuses and incentive pays. You are allowed to make a catch-up payment in the first period following the quarter if the employee does not receive the incentive bonus commission that you had thought. So at the end of the quarter, you would have to look to see, did the employee average out $913 a week? If they did not, you get that one time to make a one lump sum payment on their next paycheck following the end of that quarter to make them whole, to make them out to $913. If you do not, they are now eligible for overtime pay for that entire quarter. Okay. So there's a couple caveats here that are traps that I'd like to bring to people's attention, is that if you have an employee that you are paying commission or non-discretionary bonuses to, and they leave mid-quarter, you would need to make them whole for all of the weeks that they worked and bring them to $913. And that would have to be done on their final paycheck. And if you do go with this method, you also keep in mind that you have 1 week or one pay period at the end of that quarter to calculate your bonuses or your incentive payments so that it's on their next paycheck. Okay. So as I mentioned earlier, there's 3 tests for the exemption. Now, the job duties test is where the most misclassification occurs. So the salary level is the minimum weekly salary threshold. So currently the employees are being paid $455 a week, and they're going up to the $913 a week. And that is your base salary. So understand that that is not enough to make them exempt. Regardless of what they're being paid, they must pass the job duties test. So here is a summary of the requirements. So if we look at the 3 different categories, the executive, the administrative, and the professional, we have the 3 different tests that applies. The salary-based test means that they must be paid as an exempt, meaning there can't be deductions made that are not allowed under the federal government from their salary. They have a standard salary level test, which is making the $913 a week, or you can do the 10% with the bonus. And then their basic duties test. What are the caveats or the parameters that they must meet to be able to qualify to be an exempt? So the salary-based test, An employee is paid on a salary basis where on a weekly or less frequently basis he or she receives a predetermined amount of money, which is not subject to reduction due to the quality or quantity of work. So if you have a salaried employee and they come into work and they only work 5 hours a day, you can't deduct them. They still get their same amount of pay. Okay? And to qualify for an administrative exemption, in this case, this employee must meet all of these requirements. They must be compensated on a salary or fee basis, the $913. Their primary duty must be the performance of office or non-manual work directly related to management or general business operations of the employer or the employer's customers. And their primary duty includes the exercise of discretion and independent judgment with respect to the matters of significance. So if they do not meet all of those parameters, then they would not be eligible to be paid as an exempt employee, and therefore would then be eligible for overtime. Primary duty, which is key, means the principal, main, major, or most important duty that the employee performs. Determination of an employee's primary duty must be based on all of the facts in a particular case, with the major emphasis on the character of the employee's job as a whole. So it must be exactly what they're doing and not theoretical. So here, directly related to management or general business operations includes, and this is just a definition of this, tax, finance, accounting, computer network, things of that sort. There are some jobs that do not require that they meet the salary requirement, that the salary level and salary basis test do not apply. And that would be outside sales employees, which is key. Make sure that you're not including inside sales. This would be outside sales. Doctors, lawyers, teachers, agriculture, the motor carrier exemption, employees in certain computer-related occupations. What is key here is where we talk about the computer piece, and I will go into that a little bit more later, is that does not include help desk. Okay? There are a number of occupations in which that salary level doesn't apply. These are the ones that are most common. And I wanted to note here that in Illinois, they did not adopt the hourly rate for the computer exemption, so they would fall back to the just the normal pay under that. I apologize. So the job duties test here. We had talked about it went into effect in 2014 or 2004. And in 2015, it was proposed that there would be no change. So in 2016, effective December 1st, the job duties is going unchanged. What this means then is, although there's been a change effective December 1st, anyone that is currently in an exempt status and being paid salaried with no overtime should already be in compliance and with the regulations as they were outlined in 2004. And therefore, what you're looking at now is in 2016, with the base wages being increased, is looking at those that are already exempt and determining if you want to take them up, bump them up, or make them hourly because you can't justify that payment. So as we discussed, we're going to talk about what the next steps would be. We need to get to that point that you're getting to compliance, and we need to take a look to see what needs to be done, because what we're looking at is about 1 in 5 jobs are affected by the new salary requirements. A lot of the positions that are impacted are the lower salaried supervisors, and the industries that are seeing the most impact is retail, restaurants, services, healthcare, and nonprofits. So what should you do as an employer? The first recommendation we have, you would want to review and update your current job descriptions as to make sure that you're hitting your job duties and that you're capturing exactly what those positions are doing. Jobs change over time, so you want to make sure that you're keeping them current. You want to review your classifications to ensure that they're consistent with the FLSA requirements, and identify the jobs currently classified as exempt to see that they will be how they will be impacted by the new law. Okay, and then you want to determine how those changes will be implemented. So we're going to review the positions. Again, you're going to look at your executives, your professionals, your computer employees, your outside sales, and your administrative employees. I've given you some information here that I'll just quickly run through where you could do a quick assessment. For example, with this one, looking at their primary duty of an executive is to management of the enterprise or customarily recognized department or subdivision. They regularly direct the work of 2 or more employees. Now, what's key there is it is full-time equivalent, not just 2 employees. So it could be 4 part-time. They're authorized to hire or fire other employees or recommendations as to the hiring, firing, advancement, promotion, or other change of status of other employees given particular weight. Okay? And so what are some of the common problems do we see with that? Is that management is not their primary duty. Okay? Employees hiring and firing is purely theoretical. The employee does not have much discretion, and they devote more than 20% of their time to other activities that are not directly related to the management duties. Okay? So some commonly misclassified positions as exempt are foremen, crew leaders or line leaders, assistant managers, shift managers, department managers, or various other supervisor titles. Then you have your professional exemption again. Computer exemptions, which I had talked about earlier, is an hourly rate of $27.63 per hour, and which was not adopted in Illinois. There's a guaranteed salary or fee of $913 per week. And to qualify, they cannot be part of a help desk environment. So a help desk environment does not fall under that description of being, they must be employed as an analyst, computer programmer, software engineer, or other similarly skilled. Outside sales, again, it must be away from the employer's place of business, and that is their primary duty. Okay? Administrative duties, the biggest part here is that they exercise the exercise of discretion and independent judgment with respect to matters of significance. So, in response to the new overtime rules, what can you do? You can look at, as you're looking at each one of them, and again, we're making that assumption that they have passed the duties test. You can pay them time and a half for overtime. You can raise the worker's salary above the new threshold. You can limit your workers' hours to 40 hours per week, or you could do a combination of the above. So here's some actions that you should consider taking before December 1st, which is just 14 days away, is determine how many of your current employees will be affected by this new rule. Review your current classification of employees as exempt or non-exempt under the current regulations and state law to ensure that you're compliant. Review your pay policies and work rules to ensure that you're currently compliant, and identify the areas that need to be modified or updated. Ensure your company has processes in place to track hours, especially for those that are going to go from exempt now down to non-exempt. Determine if a salary increase for those that don't currently meet the salary requirements is financially possible. Determine if there's job positions that should be reclassified as non-exempt, and if you will allow those employees to work overtime. Tighten up your policies regarding working overtime and work with your management team to limit the number of overtime hours worked for your non-exempt employees. You want to review your handbooks and policies regarding exempt and non-exempt statuses, and review your benefits, especially if you have any benefits that variations that for exempt versus your non-exempt employees, and how a change in status may impact the benefits. So some concerns that you need to think of as you're doing the reclassification is the impact on your benefits programs, your increased compensation costs, how you're going to manage overtime, the morale and stigma of non-exempt classification for those that you're going to be changing, inconsistent classifications based on your geographics, off-the-clock work performed by reclassified employees to get work done. And that is a big one. So you've got a lot of employees, if you've got them with mobile devices and they're checking their emails, this is considered off-the-clock work, and they would need to be compensated for that. Your temptation to use independent contractors or temporary employees to catch up on that missed work, possible wage compression, and that is something that you need to take into consideration, is because you could have employees that are going to be bumped up and be close to their supervisors or their next level of management. Or what about the long-term employee that is working alongside of a newer employee, and that newer employee mentions that they just got a big bump thanks to President Obama, and somebody sitting next to them says, I've been here all these years and I am making the same amount as you. So you could run into quite a few problems with that. And you also want to check your minimum wage law. So additional action steps, you want to devise your communication plan for your affected employees. You want to train your affected employees and managers on timekeeping and other policies. And you want to modify your HR and payroll processing and IT systems. So planning is key with this. And even though we are 14 days out, you still have time to review and take those necessary steps. I know that many of you might have heard that there's lawsuits and thinking that there may be a delay. As I mentioned, we are 14 days out, so I do not foresee anything at this point being put into play that would prevent this from going through. There could be the possibility of once President-elect Donald Trump is in office, that he makes some revisions to the actual overtime ruling. It could be in the way of the increases or in the duties policy. However, we do not foresee anything at this point stopping this going into effect on the 1st. So our best advice for you is to proceed as planned. Okay? And because of that, there's consequences of noncompliance, as we all know. They're watching us, and you could be fined. So you could have Department of Labor actions, individual actions, penalties, sanctions, and you're looking at not only having to pay the employee back overtime, but you're looking at, if you weren't having them track their hours, it's the employee's word versus yours, and they will side on the side of the employee on the amount of hours that they say that they've worked. You would not only pay them the overtime, you would pay double indemnification, and you would pay double of what they would have gotten, and then you could also be fined as well as litigation. Okay, so here is our information. If you have any questions and you want to reach out to us after the webinar, you're welcome to. And we have a couple questions here, and Debbie's going to start.
Okay, very good. So we have a couple of questions that came in. One that I would be prepared to answer today is, the question is mileage and per diem paid to an employee while traveling for work taxable? So the answer to that is not if it is on an accountable plan, which means that documentation is provided by the employee to confirm that the salary, I apologize, to confirm that the mileage was tracked. From some places will require a printout from MapQuest or something to that effect to prove where you went from one place to another. Per diem would be, there are of course the Fed guidelines on what the dollar amounts are for that. But what's important is that the documentation is there, that the travel did happen, that it does exist, and that the employee is being reimbursed for that reason. And if that is the case, it is not taxable. In most common cases, this is reimbursed through AP versus payroll, although some people choose to do it on the payroll system but just have it as a non-taxable item, and that does not go onto their W-2 at all. And often this is paid after the fact so that the documentation is there, although some employers do allow for in advance on travel, and that the receipts are turned in after, and that there are any unused funds would be returned to the employer if the expense did not cost the amount of the advance. So hopefully that answers that question. If there are any follow-up questions from our participant today, feel free to submit any other questions related to that. And as Jenny mentioned, our contact information is here on the screen. So after our presentation today, if you have any questions, you can certainly contact me directly. I believe that Jenny has a question that that came in for her that she's going to address. Okay?
Yes, I do. It's for an employee who is currently exempt salary but paid less than $913 a week. Is there any reason to keep the employee salaried after 12/1 rather than moving the employee to non-exempt hourly as of 12/1? The employee meets the job duties task. So the first point that I want to make is that when this change was put into place, the government is not saying that you have to make somebody exempt or non-exempt. That is definitely the employer's call. So there would be a couple things that you would need to look at. What would be the impact if you move them to hourly, non-exempt? Not just the morale of the employee, but how many hours are they working now? Are they working 50, 60 hours a week? So look at the average number of hours that they're working and figure out how many hours of overtime that you would be paying them. And what would be the cost benefit there, or what would be the cost? So, for example, if they're working less than 50 hours a week and it comes out that with overtime calculations that they would be making $43,000, you may want to just pay the overtime and leave them and move them to non-exempt. You would have to look at the full scenario of how many hours they're actually working. If they're putting in a lot of extra hours, that would play on your financial bottom line. But you also have to look at your customer service and are they servicing customers after hours? What kind of impact that will have? And that would be internally as well as externally. Okay, and one last bit that I wanted to share is just wanting to let everybody know that there's a lot of people out there that are still a little confused as to what direction that they're going to go with. There was a survey that was just recently done by the Business and Legal Resources, and they're saying 1/5 of the respondents that took their survey are not auditing their employees to see who is misclassified as exempt. Of those, 28.1 found misclassified employees. So it's something that you definitely need to do and you definitely need to take a look at. And there's no one single right answer, and it's not a blanket action. So you would definitely want to look at each position and see which one makes the best business sense for your company.
So thank you very much for your time today. We really appreciate it.